Good morning, everyone. Cryptocurrencies have become mainstream over the past couple of years, but there's still some confusion around cryptocurrencies and blockchains, and very specifically for this audience, the tax and regulatory developments around this. So let's get some clarity. With this, I would like to welcome you to the FA News Cryptocurrencies webinar, and I thank you for joining us this morning. My name is Rianette Whitehead. I'm the editor of FA News, and I will be your host for this session. The webinar is sponsored by Jailtech, so thank you, Jailtech. Our speakers for this session is Jonty Sachs, partner at Jailtech, Dino Lazaridis, specialist financial technology fintech department at the FSCA, and Vian Olivier, partner and digital asset lead for Mazars South Africa. Please note that you can post your Q&A questions in the Q&A section, and we will try and address as many of those questions right at the end of the session. Also note that you have to attend the full session to get your 1.5 CPD hours, please. We will send out the reports. So without further ado, I would like to welcome Jonty Sachs, partner at Jailtech. Jonty will basically set the scene with an introduction to cryptocurrencies and the world of blockchain in the world of investment. Jonty, thank you, and over to you.
Renette, thank you very much. And thank you for the hundreds of people who have actually signed in. And it's really wonderful to see the interest in the financial advisory space. As Renette mentioned, my name is Jonty Sachs. I'm one of the partners at Jailtech, where we really specialize in alternative investments. We're a fund manager in the space, and we deal a lot with financial advisors. And, when we started distributing and meeting with financial advisors around cryptocurrencies, there was a lot of hesitation, and one would understand that. It's unregulated, it's very volatile, but ultimately clients are asking the question around which cryptocurrencies to invest in. And they're either doing it with or without their financial advisor. But ultimately, when clients are investing on their own behalf, they often make the mistakes that many of us do, and they invest based on discussions around the braai or around a dinner party, and they buy and sell at will and emotionally. Me personally, I'm heavily invested in cryptocurrencies, and I can't help but look at the price every single day and multiple times a day. And when clients are placed in that position, ultimately what happens, the price goes down and they want to sell, or the price goes up and they want to sell, but they're not holding for the long term. And I think that's where the injustice is done to clients, where they're not really getting enough advice or guidance around these investments. But today I'm going to be focusing on a simple introduction to cryptocurrencies. Please feel free to ask questions. I'm going to try and really simplify this. I'll use terminologies that you are used to, and they might not be technically right within the cryptocurrency world, but it will give you a sense around this new landscape, which I really think advisors need to know. So I'll kick off by explaining what blockchain is. And this is really a fundamental in this space around cryptocurrencies. And blockchain is effectively a network where there are a number of different types of blockchain networks: Ethereum, Solana, Cardano, and the list goes on. But effectively, it's a network where the peers on the network independently record and verify a transaction. Now, the independence of this is really the fundamental around here. You don't have one decision maker making the decisions. You have a community, a network of peers or nodes, which are recording every single transaction. And it's important that it's recorded individually, because it prevents fraud, corruption, and manipulation. Now, this is very different to what's happening in the real world. So if you look at what's happening, as an example, with the SARB, you have a central authority that's making decisions on behalf of, for example, the banking world, determines what the repo rate is, determines whether money should be printed, etc. And you have one central authority. Where in the blockchain environment, that authority is now distributed amongst thousands, if not millions of different people and different nodes. And there are a lot of benefits to this. Now, to try and explain this very simplistically, I'm going to give you an example. Let's assume for a moment that Postnet elects to have its back end, its back office system on the blockchain. Now, what would mean is every single branch or office would be recording a transaction. And let me give you an example. I am in Pretoria. I drop off a parcel at Postnet Pretoria destined for Cape Town. When I drop it off, the Postnet in Pretoria will register that John T. Sachs has dropped off a parcel destined for Cape Town, and simultaneously Bloem, George, Johannesburg, and all the other branches will record that John T. has done this. Now, the importance is, as the user, I know exactly where my parcel is. And what happens? Mr. Delivery Man comes, picks up my parcel, drives to Johannesburg. And when he arrives in Johannesburg, every single office or branch of Postnet will record that John T's parcel is now in Johannesburg. Now, this is important because the weak link in this whole transaction is the delivery person. So if between Pretoria and Johannesburg a parcel goes missing, there's really only one person to blame, the delivery person. When the parcel then goes across all the different regions, as a parcel would, making its way to Cape Town, every single branch office will record the transaction. And as a user, you have great peace of mind that if a branch manager wanted to collude with a driver, and they wouldn't be able to, because they would erase maybe a journal in the Bloem office, but they would then need to go and erase the journal of every single branch. Now, there's obviously basically impossible, but imagine this across millions of branches or millions of nodes. Really starts to cause a fraud or manipulation to become completely impossible. And that is just a simple way of explaining a really, really complicated technology, which has now enabled this cryptocurrency ecosystem. Now, where does blockchain fit in within the cryptocurrency world? Well, blockchain is the infrastructure. Have a look at your business. Do you use Microsoft or Apple? That is the system in which you base your business on, and then you operate using that system. And it's the same within the cryptocurrency world. You have the infrastructure being the blockchain technology that protocol or business has decided to use, and they then operate through the use of that blockchain ecosystem. Now, the real question for financial advisors is, what are the best investment opportunities? Where are the investment opportunities? And what many people make the mistake is they hear cryptocurrency and they automatically default to Bitcoin. And although Bitcoin is one of the largest players in this market, or the largest player by far, there are a number of tokens or coins which look to achieve other things. So for example, Bitcoin is a digital currency. You've got Aave, which is linked to a protocol in the lending space, in the DeFi space. You have Uniswap, which is a cryptocurrency linked to a decentralized exchange. You've got Decentralized, Decentraland, which is linked to the metaverse. So you've got many, many, many cryptocurrencies in the market which are doing things other than what blockchain is doing, and those are called altcoins. And I'm going to give you a little bit of a sense of the different options that there are in the market so that you can get a flavor of the investment opportunities. So the first one is the obvious one, is digital currency. So these are currencies that are looking to compete with the dollar, the rand, the yen, etc. And you've got your one that everyone knows, Bitcoin, which is really regarded as the store of value, equivalent to gold in the cryptocurrency environment. And then you've got other cryptocurrencies like Litecoin, again, a competitor to Bitcoin. And then you have something called stable coins. Now, stable coins are coins which are trying to achieve exactly what their name says. They're trying to be stable, or in doing so, they are typically pegged to a real world asset. So So Tether as an example, there's a dollar backing it, there's other financial instruments, and they're trying to really peg it to the dollar. And this allows transactions to be done in an environment which is less volatile than in the Bitcoin environment. Stablecoins are under a lot of pressure and a lot of scrutiny. About 2 weeks ago, one of the stablecoins lost its peg. In other words, it was pegged to the dollar value, and that peg dropped below the dollar and ultimately resulted in the coin completely collapsing. But that's a topic for another day. Now, digital currencies have gained popularity because they've got a lot of characteristics which are similar to normal currency and a number of characteristics which are better. So the first one is scarcity. Now, blockchain, there will only ever be 21 million coins. In comparison to the rand or the dollar, where the Reserve Bank can determine how much additional currency is going to be printed. And we saw what happened in America, where trillions of dollars has been printed. We saw what happened in Zimbabwe, where trillions of Zim dollars were printed. And really what happens is the devaluation of the currency. In the cryptocurrency world, blockchain as an example, that cannot happen. Digital currencies are divisible. They can really be divided into the most minute number. Transportability for me is one of the biggest selling factors here. If you want to pay someone in America and it's Saturday, well, you can make the payment. It's only going to clear probably Tuesday or Wednesday the following week, during office hours or banking hours. When in the cryptocurrency world, you can transfer money any time of day, 365 days a week, and transfer happens within a minute. It's obviously recognizable. You can see it on your digital wallet. It's durable. It's going to be around forever. And most importantly, it's decentralized. There isn't one decision maker. Now, blockchain as an example, and Ethereum and a number of others, it's taken time for these cryptocurrencies really to impact the market in terms of valuation, in terms of market cap. And as you can see over the years, it's just scaled up enormously. If you've held Bitcoin for longer than 200 weeks, to date, you've always been in the money. This is a much longer term investment, in my view, 3 to 10 years. But there are huge upsides, and I'll tell you about that in a moment. If you compare Bitcoin's performance to really any other asset class, gold, the S&P, Amazon, Tesla, the JSE, property, it's just really outperformed them over the last five years, just enormously. And there's a number of reasons for that, and I'll touch on that in a moment or two. So that's really your first investment opportunity is digital currency. The second is utility tokens. Now, a utility token is a token which is linked to a blockchain network. And there are many blockchain networks out there, thousands. But there are a number that are really the main players. And Ethereum, which the symbol represents, is the biggest. Now, how these utility tokens work is if you do a transaction on the blockchain, you need to pay a fee. And it's called a gas fee for the transaction to be verified. That fee isn't paid in rands or dollars. It's paid in the utility token or the cryptocurrency for that blockchain. So on the Ethereum network, you pay in Ether. A simple example is if you buy shares on the JSE, Straight is the settlement house, and you need to pay Straight to verify the transaction. In the Ethereum network, you use Ether to settle the transaction cost. And as more and more people use the Ethereum network, the demand for the actual utility token increases. So basic demand and supply principles apply. More and more people using the network, the value of the coin will increase. As the value increases, more and more speculative investors come in and they buy the coin to hold it, hoping for a return. And as a result, more and more people buying it, and the price will go up. Ethereum is really, in my view, the Rolls Royce of the blockchain network. And what you see here is the Ethereum logo in the middle. And many, many businesses or protocols in this space have accepted that Ethereum is the best and might be definitely the most expensive. And and they are now using the Ethereum network as their backbone. And that is really the opportunity in this space is, if you've identified a blockchain network, which is being adopted by players in this ecosystem, as more and more protocols or businesses are using the Ethereum network, there's more demand for that utility token, therefore pushing up the price. I mentioned there's Ethereum, Cardano, Polkadot, many blockchains, and they each have their own speciality, or should I say selling point. Ethereum is the most secure. Cardano, Polkadot are much quicker to transact, much cheaper, but depending on the protocol or the business, they'll make the decision which of their characteristics they need based on the blockchain. Ethereum is really head and shoulders amongst the rest. As market cap, it exceeds the likes of JP Morgan, Bank of America, Wells Fargo. This is really an enormous player in the market at the moment. So I mentioned digital currencies as an option. There's blockchain utility tokens as an option. And then third, we have something called protocols. And protocols are businesses which use blockchain as their operating system. And one which I really like, it's called Aave. And Aave is a decentralized financial institution. What happens here is if you hold cryptocurrency and you want to, and you need some money, a short-term loan, you can deposit your cryptocurrency with Aave, and Aave will provide you with a loan. The beauty here is this entire transaction of requesting a loan happens within minutes. It's really quick. Over $225 billion is already deposited with Aave. Either people are looking to deposit to earn interest, because Aave will pay you an interest for depositing with them, or they are paying interest if they are a borrower. So already $225 billion has been deposited with Aave, which is an enormous amount of money. They process a huge amount of loans, and the number of employees in this protocol is 0. It's a code, it's been set up, there are rules, and these rules really can't be broken. And if you qualify for a loan, you really get it within a minute or two. There's another example is Uniswap. Uniswap is a decentralized exchange. If you want to do a transaction across many blockchains, all you need to do is go through Aave, and Aave will allow you to access the different tokens. So you can deposit Bitcoin, and you can receive many other tokens, so that you can pay for the fee on for using a different blockchain network. But there are now thousands and thousands of protocols. This is just two examples in the market, and as blockchain and as cryptocurrencies evolve, there'll be more and more protocols in the world offering us really decentralized services at a fraction of the price. There are other opportunities in the market which I'm not going to touch on in too much detail. This is the first part. We'll be having another part in a couple of months. Yield farming, where you can deposit on, for example, Aave, earn yields of anywhere between 5 to 12 or 15% in dollar terms per year, simply by depositing cryptocurrencies on these protocols. There's NFTs. A lot of you would have heard of NFTs. This is I think it's most well known for digital art, and people are spending a huge amount of money on digital art. I personally don't understand the use case, but NFTs have a place in the world. For example, I think in time, the Master's Office could potentially convert your title deed into an NFT, into a token on a blockchain, and that will allow people to transact, buy and sell properties within seconds, within minutes, versus a 6-month process going through the Master's Office. There's also the metaverse. The metaverse is a virtual world where potentially one day we'll all be working, living, shopping, socializing, but this is still in the development. I know Facebook or Meta is investing $10 billion a year in developing their metaverse, but it's a place for a lot of us in the future, but not for everyone. For me, the next few slides are the most important, is adoption. Now, you might ask yourself, is a cryptocurrency a good investment? And what you really should be thinking is, where is it going to be in the next 3 to 10 years? And if you believe it's still going to be around, well, potentially it is a good investment. And if we have a look at other products which really took time to be adopted globally, you'd be quite surprised. So if you have a look at a washing machine, as you can see on the slide, it took many years for everyday people to use it in their home. And the most obvious one on the far right is a cell phone and the internet. And you can see how the line almost goes directly up because people started to use it at a really rapid rate. Now, what isn't on here is cryptocurrencies. Cryptocurrencies, the latest report from the Mail and Guardian is growing at 100% per year. If it reduces to 80% per year by 2024, we'll have 1 billion people utilizing cryptocurrencies. So it's growing at an enormous rate, faster than the internet, faster than cell phones. And as a result, the investability or the opportunity in this market, in my view, is really proven by this slide, that more and more and more people are using cryptocurrencies and are realizing that it's the future and cheaper to transact with, and the use cases are really growing at a rapid rate. Now, what we are seeing is we're seeing huge players in the world, big corporates adopting cryptocurrencies. You have the likes of Tesla that are investing in it. Goldman Sachs, if you go onto their website, on the homepage, you'll find news and information on what they are doing in the blockchain environment. You've got ARK Investments, who are really putting a lot of capital into the cryptocurrency market. Kathy Wood believes that Bitcoin will be worth $1 million. It's currently around $30,000. She believes that Ethereum will be worth $100,000. It's currently worth $2,000. So there are a lot of players in the market that really are backing cryptocurrencies and are investing huge amounts or millions and millions of dollars into developing opportunities of their own. Regulations. Personally, for me, I think the fact that cryptocurrencies are not regulated is really gives investors currently the biggest opportunity to invest, because once regulations do come in, we'll see large financial institutions invest in this space, and as they invest, obviously the price of cryptos will go up. And we're really seeing global adoption. The likes of El Salvador, that's really leading the space by making a Bitcoin legal tender. And there's sound bites from many countries around the world that they are moving towards regulations. The question is when. My view, in the next 18 months, we'll see a large amount of countries, first world countries, adopting cryptocurrencies, and I think that'll have an enormous impact on their value. Who should invest? Well, people who can have risk within their portfolio. If they've got too much risk, maybe cryptocurrencies isn't for them. But I do think that anyone who can handle high risk and a high risk allocation within their portfolio should be considering cryptocurrencies. The question is, for how long? So for me, this is a 3 to 10 year investment. So investors should be allocating a portion of their wealth, which they don't need, for the next 3 to 10 years. The beauty of this space is if they do need the capital, it's very, very, very liquid. They can exit their position within a couple of seconds. But this is a long-term investment. And why? So the question why is really around the return profile of cryptocurrencies. And I'll give you a simple example. If you had invested 1% of your portfolio into Bitcoin around 5 years ago, and the rest of your portfolio grew at 10%, Bitcoin, your investment in Bitcoin would make up 23% of your portfolio today. So that's the rate that this asset class has grown over the last 5 years. I personally believe that it's going to continue to grow significantly. We've seen over the last 6 months a squeeze on the price. Cryptocurrencies have dropped enormously, particularly in the last month. I think Bitcoin and Ethereum are both down 50% over the last 6 months. But we've seen this before. For investors who've been in crypto for a long period of time, they've seen bigger drops in this and a really significant return in terms of the value of the cryptocurrency market. So my personal view is that I think this is a good investment opportunity for a small portion of your client's portfolio, but for only clients who can handle some risk and are happy to be invested for 3 to 10 years. And then just lastly, our solution. So we are an alternative investment fund manager. We have a cryptocurrency basket. This basket isn't a static basket. As the cryptocurrency market evolves, new cryptocurrencies will be added to our basket. If any of the cryptocurrencies in our basket are underperforming or have a security flaw, we'll remove it from the basket, and we really back ourselves to put together a basket of cryptocurrencies better than your average investor. We've got a team that are in the market 7 days a week. We're watching developments, understanding this market, and that's what you need. It's difficult to simply make an investment and choose 1 or 10 cryptocurrencies based on current conditions. Things are evolving in this market all the time. So that's really a solution that we're offering at Geltec. Thank you very much for your time. And I look forward to the questions and the discussion in a few minutes.
Thank you, Jonty. There's quite a few questions coming in, very technical, some of them. So we will try and address some of them a little bit later. For me, the interesting part was the corporates that's really starting to get involved with cryptos. It's quite interesting at Davos that just kicked off. Cryptos is one of the main topics there too. Interesting how much cryptos are invested in the rest in Africa, a big part of Africa. And then, Jonty, is there out of interest like an age group that's more au fait to the whole crypto investment story, or have you picked up anything on that side?
Yeah, the age category is interesting. So a lot of younger investors, 25 to 35, have invested a significant portion of their wealth in cryptocurrencies. But what we're also seeing is your more senior investors now moving into the space and realizing that they have to have some allocation. But based on the a number of reports internationally, a number of surveys which we've conducted with the FA News, the real sweet spot for investors is anywhere between the ages of 30 to 45. That's where a large chunk of investments are flowing, but we're seeing the 45 plus age group coming into the space.
Great. Thank you for that. We'll catch up a little bit later with some of the questions for you. Next up, we've got Vian Olivier, who will touch on the dear tax side of cryptos, amongst others. Over to you, Vian.
Thanks so much, Ranit. Appreciate the opportunity, and thanks so much for tuning in. Yeah, I think sorry, I just want to make sure, can you see my screen there? Perfect. Okay. So as mentioned, my name is Vian Olivier. I am the audit partner and digital asset lead for Mazars South Africa. And of course, everything I want to discuss today is relating the audit side of it, the tax side of it, and of course, I've got in lowercase and small font, I've got the fraud relating to cryptocurrency, because that's not initially essentially a discussion I want to drive, but I do want to make the listeners aware of possible implications surrounding fraud in the cryptocurrency space. So for those who are not familiar with Mazars is a global international firm. We've got we're situated in more than 90 countries around the world, with more than 300 offices. And our services include a variety of services, which make up audit, assurance, consulting, financial advisory, outsourcing, privately owned businesses, sustainability, and tax. And in South Africa, of course, we're an integrated firm, so we operate in 10 offices in South Africa with a staff complement of more than 1,100. And we've got 27 offices in Africa, which essentially facilitates this whole growth into Africa, because a lot of our clients enter the market from a South African point of view and then further expand from there. So a lot of the clients that we service usually have subsidiaries or operations up in Africa. From a cryptocurrency perspective, Mazars has been dealing with various virtual asset service providers to add credentials to the industry as well, and make it more safe. So We service various clients such as the likes of Luna, who's currently South Africa's largest crypto exchange, OVEX, who's South Africa's largest OTC desk, the likes of RevX, who also provides these investment bundle platforms. Then we've also got Zago facilitating cross-border payment and remittances, Future Forex, and so on, and the list goes on in terms of clients that we service in this space. Of course, being an international firm, and South Africa almost being the crypto desk internationally, we assist on various engagements in the UK, in the US, in Singapore, and Germany, Bermuda, Cayman, Switzerland, UAE, Saudi Arabia, you name it. We've worked with those offices. Of course, one of the large engagements that we assist the US office on is currently forming part of the audit team that essentially audits one of the top 5 cryptocurrency exchanges internationally, which is quite a significant audit and quite interesting to be part of. But I think the main area that I'm sure a lot of listeners want to touch on today is the tax side of things. I think for the most part, when it comes to tax, a certain area where some of the listeners sometimes fall short is to understand the amount of transactions or taxable events that occur at any given point when transacting with cryptocurrency. So I've got on the screen here, I've got an example of various transactions just to maybe illustrate this so you can get an idea of the amount of tax events that are triggered in a specific transaction. So let's say, for example, we've got Lara here, and she receives 0.1 BTC for the services rendered. Let's say she's either providing consulting work or selling some type of good like a handbag or something of that sort. And then at that given point, the BTC was trading at 600,000 Rand. So for that one, or let's call it a 10% of a Bitcoin that she received as remuneration, she actually needs to include that into her taxable income. Now, of course, which makes this difficult is exactly what price to use when including this in her taxable income. And the reason I say this is because we've got this market of cryptocurrency and Bitcoin as an example, where in South Africa we've got various exchanges, and these various exchanges, of course, have various Bitcoin prices. There's no single national or international Bitcoin price, and the same goes with the US. The US price of Bitcoin differs from what's being offered in South Africa, and that essentially creates this arbitrage market, which sometimes makes it a bit difficult to determine what is the value of the BTC that you're receiving actually to be included into your taxable income. So what we've said to most clients is you can use various sources, but the key here is to use it consistently. So when we were working with clients and consulting on the matter, we specifically looked at something like CoinMarketCap that provides you historical data on open, close, and averages of various cryptocurrency prices. And of course, but it gives you an USD. So then you need to rework that Bitcoin price, of course, to a USD, and from the USD, you need to work that to a Rand, because of course, in your tax return, you need to declare the Rand remuneration received. And we usually go to the Reserve Bank and look at the foreign exchange on that specific day. So that is essentially just how to include it on the remuneration you receive when receiving BTC. Now, let's say, for example, that Lara goes and she decides to sell 0.05 BTC on Luna that she essentially earned from the rendering of service. So during this period, of course, the BTC price increased from 600,000 to 650,000. So you can look at the calculation that I have there on screen. I just want to grab my lady point here. So you can see you got 650,000 Rand, which is the price currently, times by 0.05 was the BTC that's being liquidated to fiat, and you take off of there the base cost. So essentially, Lara has a gain of 2,500 Rand, and of course, this is for the liquidation of the asset to fiat currency. So there's immediate gain that needs to be included in here. But what's also important to remember when we are dealing with cryptocurrency isn't a currency as defined in the Income Tax Act. Cryptocurrency is essentially an asset, so therefore we need to look at it from a barter transaction perspective. So whether you're selling an asset to basically liquidate it for fiat, or you're trading one asset for another, or you're remunerating someone in an asset, or you're receiving remuneration in an asset, you need to think of it from a barter transaction perspective as opposed to any other type of financial instrument or or a currency per se. So Laura went and she liquidated a 0.05 BTC, and of course she had a realized gain on that. Now, whether that's income in nature or capital nature, we'll touch on that in just a moment. Then Laura goes and she decides she wants to trade 0.01 BTC and she wants to buy Ethereum for that. So of course that barter transaction, and that's where a lot of people miss it. They think because you are transacting one cryptocurrency with another, it stays in the realm of cryptocurrency. There's no realization of any asset, which isn't the case. When you've got an asset being exchanged for another asset, it triggers a tax transaction. So in this event, you've got, now, of course, to the right-hand side, again, there we've got the BTC price is still sitting around at 650 Rand, and the Ethereum price is now currently trading at 45,000 Rand. So now, when you sell off that small portion of BTC, that's 0.01 BTC, remember the original base cost you paid was 600,000. It's now increased to 650,000. So you've got a gain on it. And of course, you're basically disposing of that asset to purchase another asset. So you've got a 500 Rand gain on that. But now to make matters even worse is on the Ethereum end, now you need to start recording what is the base cost of that Ethereum you essentially purchased. So you can see from that perspective, it becomes extremely difficult to keep track of it. But I'll get to the keeping track of it in a moment as well. So there is another tax event that's been triggered. Now, let's say, for example, Laura's sitting with a Luna wallet there, and she makes use of, let's say, Crypto.com debit card facility. So she can transfer the BTC from a Luna wallet to a Crypto.com wallet. Of course, that's a movement of capital. There's no tax event being triggered over there. And then essentially, she uses her debit card or credit card to go swipe at the Starbucks for a cup of coffee. So she decides to pay 0.00002 BTC for a cup of coffee. But now, once again, remember, she is liquidating, technically speaking, she's liquidating a BTC or bartering this asset for a good when she goes and purchases, which is this cup of coffee. So again, there's another realization of a tax event. So in this example, for example, the BTC price is currently trading at 700,000 Rand. So again, you need to go 700,000 Rand multiplied by the percentage or the decimal of BTC you're liquidating. And of course, deduct the original base cost. So you got a 20 Rand gain there. And then, of course, there's no de minimis rules about anything gains or losses below 100 Rand, or it's just ignored or something of that sort. You need to keep a record of this. So you need to understand that you need to keep on keeping record of all these transactions of the key, even the smallest fraction. And you can think from that perspective how difficult it will be to keep record of all this, because you're going through hundreds of transactions maybe in a year, or thousands of transactions in a year, depending if you use that debit or credit card. So of course, then let's say all of this happened in a month, and then at the end of the month, Laura comes to a statement, and she says, well, she had the original 0.1 BTC. She's used 0.05 BTC to liquidate it for real world currencies such as Rand. She went and she bought some Ethereum, and of course she went and she bought a cup of coffee. So there's essentially the amount that she's left with at the end of the month. Then of course at the end of the month, the BTC price is now sitting at R1 million per Bitcoin. So now of course she needs to calculate what the realized or unrealized gains is, but she doesn't actually need to go and do this, because remember, SARS only taxes you on realized gains. They don't actually tax you on unrealized gain. So that's extremely important, whether you're operating from a company perspective or if you're operating from perspective in your personal capacity. You need to remember that when you have these transactions, to focus on the realized gains as opposed to the unrealized gain, because you're not taxed on that unrealized gains. So the big question is, how do we keep track of all of this? You can see there's a lot going on. There's BTC flowing into the Luna wallet. Maybe you're transferring from the Luna wallet to a Binance wallet, purchasing your Ethereum there because it's cheaper on that end. Maybe for the trade for the credit card, so as I said, moved it from Crypto.com, swiped your card over there, and there could be many other transactions. You could put some of it into a DeFi protocol to receive interest, or maybe a liquidity pool to receive liquidity pool tokens, and you can do any weird and wonderful things. So there's a lot of transactions happening in the background. So the key thing here is how to keep track of it. And I think for the most part, it's been extremely difficult to keep track of these types of transactions because there is a lot happening there. But fortunately, there are tools that's been designed to essentially assist you with it. So we've been working with the guys from Recap. We've been chatting to the guys from Coinly as well, where you're essentially able to link up your various wallets through API keys, or you can import CSV reports or whatever, and then that tool goes and recalculates your taxable gain on a specific year. And the reason I would say, or I would recommend individuals to use this, to go and recalculate this manually is extremely tedious process. So I worked with another client, to give an example. They were sending from one address to another, and there was a little bit of staking taking place, and he was sending cash overseas to let's say to a website that he used for gambling, and he brought back his profits or his winnings or whatever the case may be. I think it was about 140 transactions. For the 140 transactions to recalculate what the gain is in a specific period took about, I think, 3 or 4 hours, which is quite expensive based on the charge rate of your accountant, your auditor dealing with this. And I had individuals coming to me that have 350,000 transactions being accumulated over 2 years. It becomes impossible to try and reconcile that and work out a capital gain if you're not using one of these tools. And the client I was working with actually went to the platform or the tool, and they said, well, 6.5 grand. They're not seeing how they're going to pay 6.5 grand. They'd rather want me to do it. So I'm more happy to do it, but it's probably going to cost you $500,000 rand to try and recalculate all their transactions. These tools have been created there for a purpose. It's much more efficient and much more accurate to have them recalculate taxable gain as opposed to going to your auditor or your accountant for that purpose. Now, as I mentioned, capital gains, income versus capital is probably also a very contentious topic because it's very interesting, and I'll get to exactly why. So as you saw with the previous example where we had Laura, she decided to liquidate a portion of her BTC for fiat. I think it was at 2,500 rand. So now she's got that gain. Now to determine whether that's capital in nature or income in nature. And of course, individuals will start to argue that it's capital in nature as opposed to income because of the specific tax treatment of that, but I'll get back to that in a second. So one of the biggest misconceptions that we've seen in terms of when determining whether something's income or capital in nature is individuals always run to Section 9C of the Income Tax Act. So 9C essentially says if you hold a listed security for more than 3 years, you're able to argue that it's capital in nature. Of course, SARS can look at other transactions and your day-to-day operations, and maybe you are a share trader broker and where there's clear segregation, all that types of thing. But for the most part, 9C applies to listed securities. And there's a lot of individuals that say, but yeah, I've held my BTC for more than 3 years, so I'm in the clear. But that isn't the case. 9C doesn't apply to cryptocurrencies. We haven't got the rules that, for example, in the US, they've got a rule that if you hold it longer than a year, it's deemed to be capital in nature. And based on the volatility of cryptocurrencies, honestly, myself, I believe it should be even shorter. But we need to do it in terms of what our legislation says from income tax perspective. So we look at various things such as the tree and the fruit principle. So I think a lot of individuals that have heard or have dealt with tax usually look at the tree and the fruit principle. So to give an example, so when you go out and you buy a share, and I'm not referring to trading in shares for speculative purposes, but when you're going and buying a share, that share essentially will give you a dividend. So you've got a tree and a fruit principle. You've got a capital asset, which is the share, and the income being generated from that capital asset being the dividend. So you've got that argument to argue that your share is capital in nature. The same applies when you go out and you purchase a house and you want to rent out that house. The house is essentially the tree, which is the capital asset, and the rent being generated is that fruit, is that income in nature. So when you sell off that house, of course, that's a disposal of a capital asset. Now, that's all fair and well, but how does this apply to Bitcoin and cryptocurrencies? Well, this is where it gets a bit tricky, because if you think it from that perspective, there is no fruit and tree principle when it comes to BTC, because BTC is purely purchased for speculation, for the price when it goes up or when it goes down or something of that sort. So there's no if I'm call it yield being generated there from another income stream or something of that sort. Of course, we have instances where Luna, for example, you are able to invest your BTC into an interest-bearing account, your ETH into an interest-bearing account, and then essentially you start to get that argument of a income being generated from there. But once again, we'll go back to that when I chat about terms and conditions. So what the income tax essentially says is this onus to determine whether there's income in nature or capital in nature lies with the taxpayer. So you as a taxpayer need to demonstrate to SARS whether something is income or whether it's capital in nature. But the issue that we've got here is there is a bit of lack of guidance from SARS. So they haven't really given us guidance except for saying the normal rules apply, which is a bit of an issue from that perspective, because technically speaking, what is the normal rules that are being applied, especially for this new asset class that's being dropped into current regulation? So you need to look at it from that perspective as well. So that lack of guidance, and of course, Mazars ourselves, we have lobbying this, and we have asked individuals, or let's call it lobbying and asking for SARS to give us more guidance on that. But it's been extremely slow, and to a certain extent, I can understand why it's been extremely slow, because the technology has evolved in such a way that it's difficult to keep track from a regulatory point of view. You can amend your legislations, but you'll have to get amended every single year as these new products come out of this technology as well. From a income tax return perspective, there's been a little bit of confusion as well, because your tax return actually says to you, well, you've got the option of including it under your capital gains, or you've got the option of including it under your revenue. But SARS doesn't tell you when it fits into the other. So it does create a bit of a confusing on that. I spoke about Luna savings account. Of course, there's another technical calculation that goes into that, because you are accumulating BTC on a monthly basis. So you need to go to CoinMarketCap, get the average of the Bitcoin price for a specific month, then multiply that with the average rate that the SARS usually gives you, and to recalculate your income. So that also becomes a bit technical, just to keep in mind if you are going to follow that route to try and make that argument of your BTC or ETH or USDC or whatever to be capital in nature. Now, the big question, of course, is why would someone argue that it's capital in nature as opposed to income? And it's actually quite easy to explain in this example. So we've got here, as you know, individuals pay tax on a sliding scale from 18 to 45%, all right? So when you've got that gain, so when Lara had that gain of 2,500 Rand, essentially that was included into a taxable income. And depending on where she lied on the scale, she paid tax on that percentage. Now, when you've got a situation of individual actually being able to argue that it's capital in nature, that there's a 40% inclusion that essentially applies, and you've got a 40,000 Rand annual allowance as well for the decrease of any taxable gain. So to give you an example, so we've got an example here of someone that's paying tax at 35%. So let's say, for example, they bought 100,000 Rands worth of BTC, and that BTC grew to 200,000 Rand, and essentially they decided to liquidate that or to dispose of it in any shape or form. So what happens is, if it is included in the individual's tax return or taxable income as income, then 35,000 Rand is actually payable. So remember, the individual is paying tax on the sliding scale at 35%. They've made a gain of 100,000 Rand that's seen as income because they're buying the cryptocurrency and selling it for speculative purposes. So 35,000 Rand is payable on that 100,000 Rand gain. But if they are able to argue that it's capital in nature, that 100,000 Rand gain is included into their taxable income at a rate of 40%. But of course, there's also the annual exclusion of 40,000 Rand that essentially causes them to pay less tax in a specific financial year as well. So therefore, you can see from that perspective, individuals are always trying to argue that it's capital in nature as opposed to income in nature. Some of the other interesting topics from a tax point of view is the VAT. Quite interesting enough, the VAT defines crypto assets. The income tax defines crypto. No, I'm sorry. The VAT Act defines crypto asset, where cryptocurrency is defined in the Income Tax Act, and There's a difference in the naming of cryptocurrency. Of course, the one calls it crypto asset, the other calls cryptocurrency. And we can't figure out whether that was done on purpose, but it was quite interesting when we started to look at the possible VAT implications when an individual is selling NFTs to local South Africans and, of course, exporting this to be sold on an online platform internationally. Another area where individuals get lost in as well is the way that you're taxed. Now, you as a South African are taxed on a worldwide basis. So we always get the question, if I move, let's say I want to go to my bank, I move cash from my bank to a South African exchange, I buy cryptocurrency there, I send across and I trade on the various exchanges internationally, be it Binance or Kraken or whatever the case may be. Is that taxable in South Africa? And the answer is yes, because you are taxed on a worldwide basis. So irrespective of where this income or profits are being generated, you are South African tax resident, so you're taxed in South Africa on a worldwide basis. So extremely important to keep that in the back of your head. VDPs, also known as voluntary disclosure programs, also need to be aware of it, because we've had multiple individuals coming to us and saying, well, they haven't declared tax on their cryptocurrency gains for the past 5 years. Can we please assist them with this? Now, when we go through the voluntary disclosure program route, and we actually go and sit down with SARS, and you enter into a legal agreement with them where you say, well, cards on the table, I have omitted in paying my taxes or declaring my taxes on the cryptocurrencies for the past 3 or 5 or how many years or whatever, but I want to set the record straight now. Of course, they'll waive any penalties associated with it, but you'll still be liable for the interest, because the penalties can quite large when you start to omit things from your tax return or try to evade tax. And of course, there is this belief as well that people say, well, in a 5-year period, if 5 years pass, you can't go back there, so I'll be in the clear once 5 years from I omitted to include something in my tax return. But just remember, SARS doesn't care if it's in a 5-year period. If they believe or they've got evidence to show that you're omitting information from your tax return, they can go back as far back as possible, and they can prosecute you, of course, on those taxes that you've omitted to include. The realized and unrealized gain side of things, we did discuss that as well. Ring fencing is something else to take into consideration, because you might make excessive losses in a 1 year. You can't take that losses and play it off against something like your salary or another trade or whatever. So those losses are usually ring fenced, and you can only utilize those losses against gains to be incurred or made in the future. So it's extremely important to remember that element of ring fencing as well. Terms and conditions, and I can't stress this enough. No one reads the terms and conditions ever of anything, not your cell phone contract, nothing. But when you enter into an agreement, when you enter into a situation where you are in a DeFi platform, if you are putting your cryptocurrency in an interest-bearing account such as Luno, or you are playing part in an automated market maker situation where you provide liquidity to a decentralized exchange and you receive liquidity tokens or whatever the case may be. So there's a lot happening from a cryptocurrency perspective. There is a lot of types of transactions and a lot of things happening. And you might think, yeah, but I'm just earning interest. But it might be a case of, yeah, you are earning interest, but you are receiving a liquidity pool token that gets liquidated to a stable coin. The stable coin then is paid out in the fiat currency and you liquidate it. So you can see the number of transactions taking place here. And that's why it's extremely important to read the terms and conditions, to understand what your tax obligation is from that perspective. If you think like you've got a bundle of cryptocurrency investments, let's say I go out and I buy a bundle and it's maybe got the top 10 cryptocurrency there, and I think I'll purchase this almost like an ETF to a certain extent. But you need to understand what your tax obligation is there. If there's a rebalancing taking place, you need to be cognizant of the fact that rebalancing is a disposal and a repurchase of cryptocurrency every single time. So a disposal and repurchase, that disposal triggers a tax event. So you need to read the terms and conditions of the instrument you're buying to understand what your tax obligation is from that perspective. So just keep that in mind as well. Then the other side of it is, of course, the audit and fraud side of things. And this is not something I like to discuss, but it's, of course, extremely interesting as well. And it's something that investors need to be aware of as well. So the cryptocurrency markets still is unregulated to date. And I'm hoping that the next speaker of the FSCA might have some insight on this as well. But of course, there are current laws and regulations that apply. Stuff like the Tax Act, the VAT Act, the Exchange Control, the Companies Act. And virtual asset service providers need to make sure that they adhere to these types of laws and regulations. And we've been clamoring for regulation for a long time. And maybe I think that best illustrates it is what I've got here and what happened with Mirror Trading International. So, of course, Mirror Trading International would have been required to be audited on two requirements, based on the fact that they held assets in a fiduciary capacity in excess of 5 million, and they also would have had a public interest score larger than 350. I'm not going to go into the public interest score calculation. So without a doubt in my mind, there would have been a requirement for Mirror Trading International to be audited. So Mirror Trading International was incorporated on the 30th of April 2019. They were incorporated with a February year end. So they essentially had 10 months to operate up until the financial year end. In accordance with the Companies Act, companies required to produce financial statements, or in Mirror Trading International's situation, audited financial statements 6 months after the financial year end. So that puts us at 31st August 2020. So they essentially had 16 months to do what they did. And the issue is, with the Companies Act, there's no monitoring agency making sure that even though they reach that period of 31 August 22, no one's checking up on them to make sure that they are actually compiling. They've appointed an auditor, they've completed the financial statements, and they're submitting that to Sub-C, which is the Companies Act registrar. There's no monitoring of that taking place. But if cryptocurrencies is classified as a financial asset under the FIC and monitored by the FSCA, that will essentially shorten this period. So this 6 months over year, FSCA in most instances might require to submit financial statements 3 months after the financial year end. So instead of 10 months, instead of 16 months, you've got now 13 months, and there's a monitoring agency that's making sure you are actually submitting your audited financial statements. And therefore, there's this big drive to work to operate in a regulated industry, to make it safer for the investors at the end of the day. And maybe to a certain extent as well, give you this example. So a lot of individuals has watched the Netflix documentary out there, The Trust No One, The Hunt for the Crypto King, and exactly what happened there with Quadriga. And it's quite interesting because this, to a certain extent, happened exactly the same with Mirror Trading International. And let's look at it from a financial statement and accounting point of view. So what happened with Quadriga is individual deposited $10,000 into the account, and then they bought the 0.5 BTC for that. So essentially, on an accounting base, you'll have a debit your cash, of course, cash coming in, and Quadriga or Mirror Trading International would owe the customer 10,000 Rand. So they essentially would have a liability of funds owing to the customer. Then the customer said, well, I want to take my 10,000 Rand or dollars, and I want to buy BTC with it. And of course, there'll be the second journal. They'll go and they buy the BTC and decrease the cash. So at the end, if you look at the right-hand side, that's what the balance sheet should look like. There's assets of $10,000 BTC, and there's a liability of funds owed to the customers. Now, of course, if the digital asset increased to $12,000, the customer liability would also increase to $12,000 because that's what Quadriga would owe to the customer. But the biggest thing was over here, that's that in red, that 10,000 sitting there. That actually didn't exist. So nowhere on the balance sheet were these assets actually sitting there, and no one was making sure that you've got assets that's acting as collateral for that liability that's sitting on the balance sheet, and that's where everything went south. And that's why we've also started in South Africa issuing these type of proof of reserve reports. But I'll get back to that in just a second. So I spoke about regulations. In my view, I believe regulations is needed. It'll definitely create a safer environment for the investors, and of course provide them with a recourse that if something had to go wrong. In terms of regulations, when can we expect it? I'm hoping we see regulations before the end of the year, but we'll have to see how that plays out. The proof of reserve report I spoke about there briefly. So when you have these situations where you as the user you're investing with a specific platform, but you're not sure whether your liability is collateralized, is the platform, the exchange, the investment platform, the OTC desk, whatever the case may be, the custodian actually holding that cryptocurrency on your behalf? Does it actually exist? And is it not being misappropriated some way? So what we've been doing more recently is we've been working with virtual asset service provider to issue them these proof of reserve reports. So we go in and independently verify that these cryptocurrencies either exist on-chain or within a custody solution, and when if it exists on-chain, whether the specific exchange or investment platform, whatever the case may be, custodian, actually have ownership of these cryptocurrencies. So you can go to the likes of Luno. Luno issues the proof of reserve report with the assistance of Mazars on a quarterly basis, the same with Revex as well. So we provide customers with that reassurance that whoever they're dealing with is actually credible as well. And also, I've been lobbying this to a certain extent as well in recent podcasts and articles that I've done, is you as the consumer are the only person that can force an exchange or OTC desk or whatever the case may be to provide you with reassurance as well. Are you asking the question, where's your proof of reserve report? Are you actually doing this? Asking the question, are you subjecting yourself to a audit in terms of the Companies Act? Because in my mind, no virtual asset service provider that facilitating custodian function could get away without being audited. So asking those types of questions to the virtual asset service providers that you're dealing with. Of course, you can't see the financial statement because there's a lot of confidential information included in there, but at least ask the question. I'm not going to go through the practical examples of fraud. I spoke about Meritrain International. We spoke about what happened with Kojiga. It's always important to keep your eyes and ears open, because there's a lot of people that get caught on a daily basis with these types of schemes. And I hear about them where they come out and they say they've been caught in this manner or whatever, because cryptocurrencies is seen as something that can generate a lot of wealth in a short period of time. And that is used to the benefit of these scammers as well. But sense check, just Google, do your due diligence when you invest in this. Up until the point where we're operating in a regulated industry, do your due diligence before you invest in any type of platform or something of that sort. So always to be on the lookout. But yeah, that's it from my end. I hope I could add some value and it was insightful to the listeners out there. Yeah, if there's any questions, please let me know.
Thank you, Vian. That was extremely insightful. And yes, we've got a whole lot of questions, of which I think you've answered quite a few in the early stage of your talk. Comments came in like, most people are just using crypto to avoid paying tax and interest on capital gains tax. And it's seen as a way to commit fraud. This opens up money laundering for anyone to transfer money around the world for terrorism. So I think you always get the bad part. But I think the lesson for today is you have to make sure that you speak to someone that really knows their tax laws, because I'm sure this is a lot of recent developments in the tax space, and it's a very specialized field. So I think it's quite important that people speak to the right people. And thank you for sharing your contact detail. I will get back to you with a few questions. Maybe we can quickly touch on one comment.
Sure.
That someone made. So tax loss harvesting is not exactly something that SA investors can use with crypto, ? Any comment on that?
I'm not 100% sure what they mean with tax loss harvesting. I'm not sure whether it's a case where they accumulate tax losses and trying to offset it against any other gains or whatever. But the long and the short of it is no. It's almost, and don't crucify me for using the word speculative or speculation, but it's worded exactly like that in the Income Tax Act as well, in the Tax Administration Act. When you're carrying on a speculative trade, such as the trading of cryptocurrency, is ring fence. The same happens with agricultural. So we've got clients as well that's operating in the agricultural business, and they've accumulated losses. And you can't now all of a sudden say you want to offset that against, let's say the farmer sells off and now he buys a property for the purposes of renting out. You can't then start to offset that loss. It's a ring fence to that specific trade as well, because agriculture is also seen in certain circumstances as a speculative trade. Also the same with gambling and all those types of things.
Okay, I think that answers quite a few of the questions we've seen, but we'll get back to you. Thank you for a very insightful session, Vian. Next up, we have Dino Lazaridis. Dino is a specialist financial technology fintech department at the Financial Sector Conduct Authority. And I have a feeling that quite a big part of our audience are here to listen to you, Dino. A recent survey we've done on FA News clearly indicates that advisors and planners will not touch cryptos if it's not regulated. And now that I've heard the tax part, I think they're even more nervous. So please tell us what is happening in this space, please, Dino.
Sure. Thanks, Renette, and thanks a lot for having me on the webinar. I'm going to pull up a deck and run you all through what the regulators have done with respect to crypto. And for some reason, I'm battling to pull it up, but in the meantime, just please bear with me. Here we go. Okay, great. I'll assume that everyone can see the slide deck, and thanks a lot for having me today. Thanks, Renette, and thanks everyone for dialing in. A few years ago, the regulators within South Africa came together to form the Intergovernmental FinTech Working Group in 2016. The first time crypto was on the agenda for us as regulators was the 2013 halving. The first time we put out a cautionary note to the sector and to consumers was 2016. The warning to consumers was it's unregulated. They are participating at their own risks and be cautious. But as regulators, we came together and we formed the Intergovernmental FinTech Working Group to identify innovation in the financial sector and to think about what position and what policy can look like. Part of the Intergovernmental FinTech Working Group is the Ministry of Finance, our Treasury, SARS, the credit regulator, the Conduct Authority, the Reserve Bank, the Competition Commission. So we all came together to have a unified position on crypto assets. We released various working papers, and June of last year, we, as the Crypto Assets Working Group within the IFWG, the Intergovernmental FinTech Working Group, released a position paper on crypto assets. It's been on again the radar for us as regulators for some time, but this is one paper that we put out that signaled what regulation can look like for South Africa. And I think there was also quite a bit of discussion around regulations, but we must acknowledge that regulators around the world are and have signaled a strong appetite to regulate crypto assets in some form or another to go forward. There are international obligations, which I will also speak about, that compels regulators to regulate certain aspects of it. And as South Africa, I'll be speaking about our plan and what we've done to date to regulate crypto assets. So just a quick overview of the agenda here, just an introduction to crypto assets for everyone online today, what we mean about it, what's unique about it, followed up by activities and our response to regulation, what we identified in the June 2021 paper that we put out, and the recommendations roadmap, where we are with it, as well as the FSCA, whatever we've done to date. So first off the bat, we came up with a definition for crypto assets, and I want to emphasize that we don't call it cryptocurrencies anymore. We felt that the assets do not represent currency because they don't meet the requirements of money. And there's three criteria for it to be money. So we adopted the term, or proposed the adoption of crypto assets as the terminology. What's really interesting is around the world, and there's been various studies around this, is that there's various terminologies to speak about the same thing. And this just shows you, I think, as regulators, as stakeholders, one, their various levels of understanding, as well as their divergence or coming together of the same understanding and moving and learning as things go. So we proposed the adoption of the term crypto assets. We defined it as a digital representation of value, which isn't issued by a central bank, so it's not as CBDC, a central bank digital currency, but it is capable of being traded, transferred, or stored electronically by a natural or legal person for the purposes of payments, investments, or other forms of utility, which is all encompassing. They apply cryptographic techniques and uses distributed ledger technology. So this is the proposed definition of crypto assets that we put in the paper. If we have a look at some key financial activities, identified in use cases, investments obviously comes up, as well as capital raising. When we started drafting the paper, it was a 2017-2018 initial coin offering frenzy currently taking place. So that was a big use case, but it still is a use case today in some form or another, followed up by payments and trading. But the enabling technology here is blockchain or distributed ledger technology. And what is a blockchain, right? And I think the previous speakers and John T had a really good example of it, but it ultimately is a sequence and series of records that cannot be altered and is managed by a large body of computers. So if you think about all of the blocks on these various protocols, it records every transaction that ever has taken place since its inception, and various protocols have been set up from 2009 onwards, Bitcoin being the most popular and the most liquid crypto asset and the longest chain. But every single transaction is recorded on the blocks. I think there's 722,000 currently on the Bitcoin blockchain. But if you come up with a bit of an easier explanation, it's basically an Excel spreadsheet, this blockchain, in a PDF format, which all of these computers keep the most current version, and they agree on this most current version simultaneously. That's all it is. It can be seen as a next version of the database. It's just a PDF Excel spreadsheet, which makes it a lot easier to understand. And on the spreadsheet is the sender and the receiver of these crypto assets. But it does, and it is a very empowering technology. We identified 5 use cases for crypto assets in the paper: trading, buying and selling, payments, initial coin offering to raise capital, investment funds, and market support. Trading, I think it's self-evident, willing buyer, willing seller, payments for one user to another for goods and services, initial coin offering to raise capital. Bearing in mind that it's not any type of capital, it's generally capital in the form of other liquid crypto assets, and it can be seen as funding early stage tech companies. All of the companies with and who have raised funding use this underlying technology, and they attract funds to have some type of link or ownership in this project. Investment funds on various forms, that was also discussed earlier. The market support, where there's services which are used to empower and to ensure that the technologies and the protocols function, and there's services around that which can be complex, and the need for various services which I will unpack a bit later. But crypto assets have grown rapidly over the years. This data is slightly outdated, but the growth has been exponential from a user base and from a trading volume base. The latest figures are a lot larger than this, and I'll speak about it in the next slide here. So if we just have a look at the SA crypto assets landscape, it's too big for us as regulators to ignore anymore. We do have bad examples that was identified earlier on of large amounts of funds being taken from consumers. We roughly have 12 crypto asset trading platforms, such as some common names known to the attendees today, such as Luno, Altcoin Trader, Valar. But if we just have a look at how many Bitcoins are traded, in the region of 1,000 and 4,000 per day. Bitcoin is still the most dominant traded asset in the country, between 75 and 85% of traded value. And there are some days that $150 million is traded in Bitcoin per day. We do estimate that there's over 3 million retail investors in the space. And if we just have a look at the payment element of it, generally it's not used for payments because the underlying protocols don't serve often, especially the dominant protocols, as a very efficient payment mechanism for high transaction fees and time for the transaction to clear. So if we just have a look at some crypto assets, it has resulted in several market conduct risks that we are concerned about as FSCA, that we are monitoring. Consumers aren't always fully informed and understand what they get themselves into. Fraud and cybercrime are huge problems. The thing about the technology that makes it very innovative also is a risk for consumers. How the message to send a payment is also the value, which is a bit different to the current technology, is a risk. And it not being reversible is also a risk for consumers. And it's become very attractive for ransomware and for phishing attacks, where consumers' assets in crypto is stolen, and it is extremely difficult to be retrieved. There's also failure of service providers as a conduct risk identified. Maladministration, which was also spoken about previously. The Quadriga example is a classic example of this, where these institutions offering services for customers don't do what they promise, and they steal consumers' funds. There's also unclear price formation and price practices for consumers. There's quite a bit of complexity around this. There can be excess fees and misleading advertising. A fancy lifestyle, fancy assets isn't always what the majority of consumers experience when trading in this asset, especially when they hold it on the short term, followed up by volatility, 20, 30, 40% turns in a single day or a couple of hours, can affect consumers negatively, and complexity. If we have a look at the terminology also in this space, it was clearly designed by computer programmers. When you speak about wallets, proof of work, proof of stake, staking, it really is not very easy concepts to understand. Hardware wallet, private wallet, public key followed up private key. It is complex terminology, and for the average user, it is still complex. For the intermediary user, there is quite a bit of complexity that we identified in this market. Okay, so there are vulnerable consumers that we are at risk of fraud. Quite often, when it sounds too good to be true, it often isn't. We as regulators always push for customers to invest in regulated services and offerings, and we caution when they invest in unregulated. But at the same time, we don't ban consumers from investing in unregulated activities, but we do think that they should be aware of the risks. Crypto assets generally are unregulated, and I will speak about this a bit later. There isn't any claim, and unfortunately, the FSCA cannot help much currently with these problems currently taking place. But crypto assets are high risk. They are open 24/7, the markets. There are 24/7 scams. There are various techniques that criminals, as a job, is to be a criminal, and they've been very innovative in the space. The FSCA Enforcement Division currently has 30 crypto-related cases underway. There's been 22 public warnings put out, issued with respect to companies, and 2 general warnings. Scams are easy to hide, and they are difficult to investigate without quite advanced subtech tools. Some examples was Mirror Trading International, which I won't dive in too deeply, but it is a bad example that we do have as South Africa. So activities and our response. What did we identify in the crypto assets working paper to take forward for crypto assets? So we identify crypto asset service providers as CAPS. Internationally, it has also been referred to as VASP, the virtual asset service providers. They do mean the same thing, but for crypto assets trading platforms, for the exchanges, we proposed for the South African Reserve Bank FinServ department for the CASP to register as a crypto asset trading platform in terms of the exchange control regulation, in terms of the FRC for AML and CFT, for the CASP to register as an accountable institution for the money laundering element, and their FSCA to be the lead regulator to license these crypto asset service providers in the form of crypto assets intermediaries or advisors, which I will chat about on the later slide. Crypto assets vending machines, the same treatment as crypto asset trading platforms. Crypto assets token issuers, the proposal here is under SARB FinServ to register as a crypto asset trading platform, under the FIC to be an accountable institution, and to register the service or the advisor element as under the phase Act. Then there's a digital wallet element to it under the SARB FinServ to register in terms of the exchange control regulations, under the FIC again as an accountable institution, and to be licensed under the FSCA. The other activity identified was crypto assets funds and derivatives, which is currently being licensed by the FSCA, but the position put out in the paper is crypto assets funds and derivatives to not be allowed for various reasons that we put out in the paper. And then custody, this was also a service to be licensed with the FSCA and register as an accountable institution under the FIC, as well as exchange control regulation under FinServ. So where are we with everything? There's various balancing balls. We have the FinServ, which regulations are approved by the Ministry of Finance. So the minister there would approve any changes, as well as the FIC. The Minister of Finance would approve any amendments to the Schedule 1 of the FIC Act, as well as the licensing framework under the FSCA. Under the FIC, the Schedule 1, adding CASPs as an accountable institution. This was with the Minister of Finance. He has sent it to Parliament for parliamentary comment before it can be amended. The Schedule 1 of the FIC Act, bringing in crypto as a service providers as a whole within the AML CFT realm within the FIC Act. There is also constant monitoring that we are doing as a crypto assets working group with respect to progress being made, and having a look at the ecosystem as a whole. When we developed the paper, there's been significant other use cases such as DeFi, decentralized finance that was identified, NFTs, the metaverse, GameFi. These are all new developments that have grown exponentially over the last 18 months, as well as stable coins and algorithmic stable coins that did bring the market down a few weeks ago. The status of crypto assets as legal tender, we have not signaled any change there. The status quo will continue, and the current stance, we don't see these unbacked crypto assets as money and as currency. Simul settlement, so this currently is not allowed. using crypto assets to settle obligations, but we do have Project Corker 1 and Project Corker 2 exploring central bank digital currencies for settlement purposes. Under the supervisory and regular approach, the Prudential Authority is overseeing the developments in the market. Under the FSCA consumer education, we are constantly educating consumers. Part of our Money Smart Week, we had a dedicated session on crypto assets. Having said that, there is a lot of appetite from consumers to understand the market and understand what is happening. I will chat on the next slide about what we are doing as the FSCA, but I'll just quickly update everyone on the other regulators. FinServ, the amendment of the EXCO regulations. This again has to be done by the Minister of Finance, as I alluded to, and the definition of what capital means. Currently, it's for the purposes of the exchange control regulation, and that's a specific section 10.1c. There's also the Adler manual to be amended and the Adler framework. Currently, like I said earlier, pension funds and CISs are not allowed exposure to crypto assets. That was the position that we all put out. We also identified that we are constantly keeping an eye on the market and having a look at previous positions that we put out. There is the NPS bill as well, so that's the payment system bill. We are also exploring what alternative payment mechanisms can look like, and possibly exploring this in our regulatory sandbox, crypto assets payments. With respect to ICOs, what do we and how does this look like for regulation, for raising capitals, particularly for small scale fundraising, as well as derivatives? This currently is not allowed exposure to crypto, and this was the position that we put out. With respect to us as the FSCA, currently crypto assets are not captured as a financial product under the FASE Act. We did put out a draft declaration on the 20th of November 2020, where the FSCA proposed to include crypto assets as a category of a financial product under the FASE Act, which would mean that the services and the FASE Act would apply if this is finalized. We did receive comments until early last year, the 20th of January. Comments were received and considered and assessed. There was an intention to publish a roadmap providing more detail of the status and the process going forward as the FSCA, but there were broader developments around crypto assets, and the draft roadmap was put on hold until there was further technical analysis of the market done. The technical work also includes issuing an industry survey, and a lot of the participants on the line has probably received that. That was done on the 14th of April of this year, and the time given to complete that is the 31st of May. To get a better understanding of the market built up, and with also other technical work which is currently taking place. Once this is complete, a decision will be made on the draft declaration and taking that forward in some form under the FASE Act. The categories identified is crypto assets exchanges, custody providers, wallet providers, and advice. The FSCA is internally deliberating on the risks and the benefits and the priorities of the use cases. But there's a broader discussion also currently taking place under the Conduct of Financial Institutions Bill, under the COFI Bill, a more permanent home for these services and crypto in general. But ultimately, it would be if crypto is taken forward, the regulation, the licensing, the supervising, and the investigating of these services under the FSCA as the lead regulator. Accompanying them is and us as the FIs is the FIC under the AML's CFT requirements, and the accountable institution, and the FinServ colleagues at the central bank. And that's our update on crypto regulation from the FSCA. Thank you very much. I don't know if there's any questions.
Yeah, no, there is questions. I'll ask you a few a bit later, but first, maybe we can start off with, and I maybe missed that you have given an indication of your process and your timelines, but is there a closer timeline that you can give that you think things will be finalized?
Yeah, Rened, I think there's a lot of work which has taken place. There's a lot of work currently taking place, and the spectrum of what the final outcome is still quite broad, but there is a move to narrow that down to finalize that. What the process means when it is done, it could be the licensing, it could be the supervisor and the investigation, and as the FSCA, I think we're very aware of what that would mean. There is various amounts of balls for this to be finalized, and I do think that we're probably at the tail end of it. The indication that's been put out, which I think is a pretty accurate one, is before the end of the year, and
okay,
and that would be probably a good estimate of when crypto regulation in some form can be finalized.
Okay, that is good enough. Before I go over back to Jonty, Dina, what is the FSCA's view on advisors who have obtained blockchain and crypto advisor certification from an overseas institution is one of the questions.
Sure, so that's a great question, right? And the thing is, if you have a look at the accreditations currently in place, there isn't really that much in the space of DLT and these type of assets, and the way that the market is also developing, it's changing on a weekly basis. Innovation in the space, and that's one that we also had a discussion about, particularly around the FASE Act and competency and proven competency from these institutions. A proposal has been put forward on what that can look like, but we do acknowledge that it is a challenge for us as South Africa and internationally. So we also had a chat with other regulators, and it's a worldwide problem. How do you prove understanding and competency in a space which is so new? Quite often the institutions and the accreditations take some time to be finalized. But it is one that we are aware of. We do have a proposal, but it still has to be approved to take it forward. Yeah, I think that would probably be a good summary on accreditation.
Thank you. I'm transferring another question, very informative, but need clarity whether insurers are allowed to insure it as money and in their BI.
Sure. So I think that would probably be a better discussion to explore with the Prudential Authority. I think as money, it doesn't meet the definition of our criteria for money, right? For its various reasons, it's not legal tender. If it's seen as an asset and an insurable asset, I think that would probably be a good starting point to take that forward. And then also a line being drawn on what risks are being covered, what risks aren't being covered. The other interesting part about it is on the asset itself, right? So if you look at, and Jonty chatted about the Ethereum protocol in quite a bit of detail, which was great, but there's still a lot of exploits currently taking place with these contracts, with these protocols, where hackers are finding loopholes and pulling all the assets. I think the server, I think one from a money perspective, no, it isn't seen as money. As an asset perspective, what asset should be explored? And then to take that forward, it would probably be a PA discussion. Having said that, there are some insurers around the world who are insuring the custody element of that. And this is particularly around the cybercrime and the cybersecurity, if certain measures have been put in place. To my knowledge, there isn't any or very little SA examples of exposure to this type of risk. It's often been done by international insurers.
Thank you, and thank you, Dino. I'm going to go to Jonty quickly. Jonty, as with everything, when things mature, the investment, no, that's not what I wanted to ask. What are your thoughts on the greening of the blockchain, like the way Algorand is claiming it's doing, following the principle of ESG? Can you touch on that for us, please, Jonty?
Yeah, I think blockchain, Bitcoin in particular, has gotten a bit of a bad rap around energy usage. What a lot of miners do is they locate themselves near, call it solar plants, or use more energy efficient means, because it is very expensive to run. And you've seen the likes of China banning mining for that reason. If you compare it to gold, what uses more electricity? It's obvious the gold. A lot more electricity, a lot more power to produce. But it is a concern. What we are seeing is blockchain technologies moving from proof of work to proof of stake. And proof of work requires many computers to verify transactions, where proof of stake uses a much smaller base. I'm not quite sure what exactly Algorand's doing in this space, but I do know that it makes sense for a lot of blockchain technologies to move to more greener, more cost-saving ways of mining. But a statistic that I did see is, the cryptocurrency environment is using something like 0.1% of the world's energy consumption to mine cryptocurrencies. But it's definitely something to keep an eye on.
I have more than one question. I'm going to wrap up soon because the time is up, but one or two questions more. Jonty, I had more than one question on your view on XRP.
Yeah, South Africans love XRP. I'm not 100% sure why. So it's obviously a payment token or a digital currency. It's had a lot of difficulties in America. The American regulator has been in a long case around it, and the jury's still out what their decision will be. So there is speculation around whether it'll be, where the decision from the regulator will go. So at this point in time, it's more speculative than most. And the problem I personally have with XRP is it's not very decentralized, it's centralized. Ripple is the main, call it fund manager, intermediary, or issuer of the coin. So, if you're a pure cryptocurrency person, because it's not so decentralized, I would stay away from it. But, for whatever reason, South Africans really love XRP. But I'm not an investor in this type of token.
I'm going to ask one question for Vian, and then I'm going to wrap up, and I'm going to ask my presenters if they would be keen to answer some of the more specific questions in a different way personally later on. Vian, a question: could the capital gains tax versus income tax be distinguished when one puts a client through the filter of being a trader or an investor, i.e. trader potentially using the arbitrage gains as part of income versus investor benefiting from portfolio appreciation over time and then withdrawing capital gains tax?
Yeah, there's definitely an argument there to be made, but once again, it's one of those situations is what you can prove. So for the most part, we've advised clients as well, if you want to follow that route, while waiting for more clarity on this, there needs to be clear segregation. Give you an example, if I'm looking with a share portfolio as well. So my personal share portfolio, I've got it split between two different, if we call it intermediaries or custodians, or whatever the case may be, to have a clear segregation of this portion relates to income, that portion relates to capital. But of course, once again, it becomes difficult. That's a simple example. But to give you another example, if you are, for example, utilizing the arbitrage, or let's call it making profits of the arbitrage between the various currencies internationally, then sure, you are expropriating capital, you're bringing cryptocurrencies back and you're selling that off for a profit. But if you are allowed to have long-term investments in cryptocurrencies as well. It's the same example if you're a property developer. You are allowed to build properties and sell it off, but also own your own property. That would be seen as capital gains when you essentially dispose of it. So the biggest thing is just to paint a picture, and there's no clear one golden bullet or silver bullet rule and say this is how it works or whatever. You need to paint a picture of exactly what you are trying to achieve at the end of the day.
Last one, Vian. And before I go on, I can say that you will receive your CPD certificate from us. You don't need to complete anything. I see there is a question. If you've attended your hour and a half, you will get your CPD certificate in your inbox. Vian, question, please explain how clients who generate or accumulate BTC, Ethereum, etc. through mining rigs that carries an upfront capital outlay are taxed if these rigs are purchased in a company. That sounds very technical.
It's not too bad. Just maybe on what Jonty was elaborating on as well regarding the whole ESG prospect of the mining operations, and it was quite interesting. I was in Miami at the Bitcoin conference a couple of months ago, 2 months ago, and one of the topics that they discussed was the energy usage and ESG relating to cryptocurrencies such as Bitcoin. And Bitcoin is almost a more superior way of transacting and moving value over the internet. So it's expected to use more energy. The same goes to things like washing machines. We can wash our clothes with our hands as well, but we decide to use something more technologically advanced to basically facilitate it. Same, we can ride bicycles, but we decide to drive cars. So it's the evolution of the world and us as individuals to use more technological advanced ways that, of course, does require more energy. How we solve the energy crisis is a completely different ball game from that. But on the mining question itself, so let's say, for example, you need to buy the hardware, you need to rent the property and all those types of things. So from that perspective, you do incur expenditure, of course. Now, of course, those are capital type of assets. That's hardware that you're purchasing as a capital asset. So that, of course, it basically decreases your taxable income because you're able to claim the wear and tear. The rent that you're paying, you're able to decrease your taxable income. So all of that builds up almost like let's say, for example, I'm just putting this into layman's terms. On the first month, you were successful in getting one specific block reward, so you weren't able to get any remuneration for that. But you've accumulated these losses. You've got your wear and tear, you've got your expenses, maybe you've got some your rental premises, your electricity bill, all those types of things. So there is a lot of expenses. Now, of course, when you generate that income, you are able to deduct the expenditure that you require to generate the income, which is as defined in the Income Tax Act. So that expenditure that you, of course, I'm talking about electricity and those things, you're able to deduct of that. And the same applies to all the hardware that you purchase. That's basically depreciated over a period of 5 to 6 years or whatever the case may be, depending on what the 8th schedule says, but you are able to decrease those taxable income. But let's say, for example, if you take a wild, and this wouldn't happen, you wouldn't be very profitable. Let's say, for example, you had a year and you had no income whatsoever on mining rewards. So, of course, you would have accumulated all these losses, whatever, that can be offset against your income in the future for the specific entity you're operating. I hope that answers the question.
Yeah, it still sounds technical to me. Yeah, thank you for that answer. I think that's a wrap. I will go through the very specific questions and send it to you guys to adopt an answer for me to send to everyone. It's a wrap. Thank you, Jaltex, for sponsoring. Thank you, Jonty. Thank you, Vian. Thank you, Dino. I think it was extremely insightful, very positive feedback, and maybe we'll have to do a follow-up at some point. But thank you for your time this morning and for all the people who tuned in. Thank you, and we'll see you next time.